Hi, I'm Paul Feinberg, host of UCLA Anderson's podcast. I'm here today with UCLA Anderson Ph.D. candidate Bernardo Morais. We'll be talking about some of his most recent research. Bernardo, why don't you just start by bringing us up to date, tell us a little bit about your work.
The main topic of my interest is the impact that investor protection has on the cost of credit and therefore on the behavior of firms. Why is this important? Well, investor protection impacts the cost of credit because in case of the cost of credit depends mainly on two things. One is on the probability that the credit is going to default, and the second thing is, well, in case it defaults, how much do you recover, how much do you recoup? So one measure of investor protection is the recovery rate in case of insolvency. So for example, in countries where the recovery rate is large, means that you as an investor are able to recoup a larger fraction of your investment. And so I'm trying to analyze what is the impact that this investor protection has on the cost of credit and therefore on the behavior of firms and finally on the aggregate economy. So one thing that I find, just to give you some numbers, for example, in Russia, Hungary and Bulgaria, the recovery rate is around 25 cents on the dollar. So for each dollar that you lend, you as a creditor lend, in case of insolvency, you expect to receive 20 cents. And this value is relatively low. For example, in the US, this value is 85 cents. So, and because the cost of credit depends not only on the probability of default, but also on the cost of credit, on the recovery rate, the countries with the bad debt enforcement, with worse recovery rates, they're going to have a higher cost of credit. And why is this important? Well, credit is fundamental for the life of firms. To give you an example, 85%, the leverage ratio of the median firm in the US is 85%. What is leverage? Leverage is total debt, so over total assets. And total debt goes from supplier credit to more longer term credit. And so firms are very much dependent on credit for their living, for their day-to-day actions. And if the price of credit is higher, they are somewhat impaired in their actions. So what I find is that in countries where debt enforcement is larger, firms, when they enter the market, they enter with fewer own capital, they ask for less debt. And so because they ask for less debt, they will start smaller. Because they start smaller, they take more time to get to their optimal size. And what this makes is that the value of an entrant firm in Russia, for example, with a low recovery rate, with a high interest rate, the value of a firm in Russia, just because of this difference in the quality of debt enforcement, will be lower. Now, so this is a problem, but it's not the biggest problem. So imagine that you're a manager of a firm, and the firm has 10 years and it's already a certain size, and for some reason your business worsens a little, and you don't expect it to become better anytime soon. So you have two options. You either quit your business or you continue your business. If you quit your business, you have one of the alternatives that you have is to start a new business. But the problem, for instance, in countries like Russia, where the value of firms is lower, where the value of starting a new firm is lower, is that this outside option of starting a new business decreases. And so what this makes is that sometimes firms that aren't so good, whose productivity is bad, they don't get out of the market, they don't re-enter at a later stage. Whereas in the US, if you open a business and you see the business is not very good, you immediately you have a bigger incentive to exit and to retry. So you have more trial and error going on, a bigger selection effect going on in the US.
Okay, let's take a little half step back from the research, kind of go before this work. What brought you to this topic? What was interesting about it for you? Why did you choose to delve into this?
Yes, so I think the quality of investor protection, the quality of the legal system is very important, and that was basically my motivation. And what I try to do with my research is try to quantify the importance of the quality of the financial system, the quality of the judicial system. And what I found, so I basically built a model and to quantify the impact of the judicial system on the interest rate and therefore on the economy as a whole. And what I found is that the judicial system, these differences in recovery rate, are able to explain up to 30% of the differences across country in income per capita. So the importance of the legal system, on the impact that it has on the cost of credit, is very important to explain cross-country income differences. And this will also alert policymakers that the quality of their judicial system, the quality of debt enforcement, the quality of investor protection is very important to improve income level in those countries.
So let's delve into that point a little bit more. That seems very significant. The weaker the recovery rates are, has a real impact on per capita income and therefore on the lifestyles of your citizens. Is that what you're saying?
Exactly. So if in countries where the recovery rate is going to be lower, because the interest rate is going to be higher and because the value of firms is lower, this has large impact in the quality of living of the citizens because it impacts the quality of firms. And the production of firms is a major share of the GDP of an economy. And because you will have lower quality firms hanging around in countries where the cost of debt is higher, you don't have the Googles like you have here in the US, you don't have the Apples. You have older firms lingering, and there's not a lot of turnover that should be occurring.
Are there any impacts on international investment? Are people less likely to invest in Russian businesses or Bulgarian businesses because of these recovery rates? And is that why outsiders or foreign investors are more interested in investing in companies here in the U.S.?
For sure. So we just had some examples in Russia where certain oil companies were expropriated. So that also is related with the rule of law. And therefore, basically, when the risk of something increases, what investors do is that they demand a higher price, they demand a higher premium. And so what we have in countries like Russia, where expropriation rates are very high, where the rule of law is lower, you basically demand a higher risk premium. And so you'll have less investment because of that.
In your opinion, on whom is this new knowledge most impactful? Is it on investors, or is it on the government entities that might help regulate or improve recovery rates in countries where they're weak?
Yes, so I think we can think that everything that has to do with institutions, with the way a country works, is relatively hard to change. Although, basically, what I would say to countries like Russia, Hungary, Romania, where the rule of law is weaker, where the debt enforcement is weaker, I would tell them, to policymakers, I would tell them we should improve the quality of debt enforcement. But I think they know that. But one thing that it's easier to do, and that has also some impact on the cost of credit, is an increase in the punishment for a defaulter. For example, in the US, when an individual applies for default, he applies for Chapter 7, and credit rating agencies are allowed to have him on record for up to 10 years. So basically the punishment is that you are flagged as a defaulter for a period of 10 years. And a punishment is bad, and it disincentivates default. Why? Well, because when you are flagged, you will have higher interest rates, lower access to credit. So what I would advise some policymakers to do, and what I find with my model, is that in countries where the quality of debt enforcement is weaker, the punishment should be larger. Why? And by punishment, I mean exclusion from credit markets. So this exclusion from credit markets, the length should be larger. Why? Well, if the punishment is higher, you're diminishing the incentive to default. By diminishing the incentive to default, you are decreasing the probability of default, so you will decrease the interest rates that are demanded from those countries. And so in these countries, it's important to decrease the interest rates, and by increasing the punishment, you are doing that. Now, in a country like the US, this punishment shouldn't be so large. Why? Because there's something bad related with punishment, and that is, if punishment is high, let's say that you have a business, you want to invest, but business is risky. So because you don't want to default, because punishment will be high, you are more conservative. So you may forego good investment opportunities. You will grow more slower, just because of this higher punishment. So what I find in my model is that in countries like Russia, the punishment should be on average 10 years, so you should be excluded from credit markets for up to 10 years. But in countries with a recovery rate similar to that of the US, the punishment should be lower, should be up to 2 to 3 years. So I think that my model, my research, has some direct impact on some actions that policymakers should do. In this case, on the quality on the length of punishment.